All right, looks like right now would probably be the perfect time to show you a live simulation trade of how to short a stock. This is my demo account with a balance of 284. And I was in that US 30, so I stopped paying attention to it. Let's do it like this actually. Hold on. All right, here's a different demo account where the board is clean, no open trades. The other one, I was in US 30, but it was an index, and the indices close at 5 p.m. on Fridays. As you can see, the only thing moving on my screen, on my quote screen, is Ethereum because I'm on Metatrader 4, which is the platform for Forex trading. There's thousands of brokers, but there's really like only one platform, and it's MT4, Metatrader 4. Um, Forex trading, the only thing you could trade on the weekends with most brokers is crypto. Um, some brokers won't allow you to trade crypto on the weekends. Um, but it's the perfect time to short stock, it's looking like. Why? Why are we shorting this stock? Number one, this is straight technical analysis too, no fundamentals. Fundamentals would include like forexfactory.com, going on there, looking at monetary policy reports for different countries, unemployment, like the non-farm unemployment report. Um, those are all fundamentals, but technical analysis is chart patterns, candlestick patterns, this yellow and red line, which are moving averages. This is the 200 moving average line for long-term trades. The red line hugs the candlesticks a little closer. That'd be the 50 moving average. Better example would be like here. Perfect example. How the red was far away, but the further it dropped, the further away from the yellow line it got. The further it dropped, the more the red line came back to the candlesticks. The MA lines are, my opinion, the strongest indicators because the candlesticks will always come back to them because the market always retraces itself. So this would be demand when it's dropping. Or supply, right? Because this is people selling. If they're selling, that means the supply is going up, right? However you want to look at it, supply or demand, the market always retraces itself. So if it's doing all this dropping, that means either previously there was a lot of bullish action, or next it's going to be some bullish action. And it looks like the reversal is right here. It's going bullish right here. So let's see what happened previously. All this bullish action got retraced right here. All this supply got matched with demand, or all this demand got matched with supply. I forgot how it goes, but either way, the concept still applies. Much like what's about to happen currently, this is about to repeat. Right now, a high was met, but it wasn't as high as this one. So the market is about to go down, and it did. If you were to get in a sell, or if you were to short, oh my God, ain't no telling how much money that would have been. And just held it for hours, according to your confluences and confirmations. Let's fast forward. See what I mean? That double top high, but the second tap was lower than the first one. Then you already know. Also, what time it is. It's 4:55. If I'm in the hour candlesticks, that means this whole wick was a candlestick, right? It was a bullish one. Price opened even with the last hour. And it went down first, rejected, went all the way up, but didn't make it as high as its most recent high. So then the bears start taking over again. They start pulling that bullish black candlestick down until it met where it's at now. and it's going to become a bearish candlestick. When the next hour opens, if it is a bearish candlestick, I'm going to short it. If it ends up a bullish one, it'll probably look like this. But as you can see, all these indicate that the market's going to go up. I tell people to look at this one right here or this one right here. The block, look at it as knuckles, right? And this long wick is a pointing finger. It's an index finger. It's pointing up because it's telling you literally the market is expected to go up pretty soon. Like if this block was a knuckle, this would be the index finger pointing up. So if you have a block in the middle, it's like indecisive. Or if you have like a straight line in the middle of a wick, it's indecisive. Don't know where it would want to really go. Just like right here, I'd be weary of that. And then if this next one open with the block at the top, it's a hammer, which is kind of a fake out right here if you ask me. Because a hammer indicates price reversal. If you see a hammer at the top of an uptrend, bingo. Or if you see a hammer at the bottom of a downtrend, bingo. Then it indicates hammer, price reversal. So I'm surprised the market didn't drop after that, and it's probably because it's a bullish hammer. A bullish hammer versus a bearish hammer. Like right here, great example. Bullish action. Got knuckles right here, long index finger, so the market should go up after this, and it did. But then you have a hammer because the handle's longer at the bottom, the block is towards the top, and it's bearish. So it stopped the bullish action and indicated price reversal to bearish. So now that you have this trending line right here, market's going down, the bears are more powerful within this hour. Even if it ends bullish, I'd still be expecting to short it. And I'll probably get away with a quick scalp, but overall, it may be breaking its high. This could be a bullish market very soon. Another reason why is this. A reason why it could be bullish and not bearish is because it needs to form the right leg of an M. All right, it's 5:02. This is what I mean. The first 5 minutes within the hour, when the new hour starts, because all I do is trade off the hour candlesticks. The higher the time frame, the better the confirmation. The better the confirmation on what the candlestick patterns are. So I'll talk about the hanging man in a second. The hanging man is what I used when I upped my lot size to a 0.33 and hit sell on gold, and it dropped $3 and made me 102. And this was a process of like 5 to 10 minutes. Because what I was doing was when the hour started, I was waiting for it to pump fake to the top side and then eventually drop like I knew it would do. The opposite is going on here. I'm thinking it's dropping, but the drop is the pump fake. Well, not the pump fake. I guess you could say the drop fake. Because it's already wicked out. If you could barely tell, but the wick is right here, right? The bottom of it. So in the first 5 minutes, it's dropped to this point, but it's already rejected all the way back up. I'm waiting to after about 5 minutes to confirm if it's going to drop past this point or if it's going to return back to open price. If it returns back to open price, then it's going to be, in my opinion, a bullish market the way I'm expecting it to be. Also because at the bottom, if you notice at the bottom, it hasn't There's this blue line. There's these levels right here. Excuse me. 85, 85 and 75. It's supposed to be 72, or 82 and 75, and 16 and 25 at the bottom. This box at the bottom is the oversold region. This is the overbought region. Usually when it's in this box or a little bit above this line, it has nowhere else to go. It's going to be dropping soon. Same thing with the bottom. Usually when it's in this box or under this box, it has nowhere else to go. So it's going to be jumping up pretty soon. And the only two indicators I use is the RSI, which is the relative strength index, and those two yellow and red lines. The yellow one is the 200 moving average for long-term investing and or going like swing trading a couple of days. Holding a trade for a couple of days is swing trading. And the red one is the 50 moving average. It hugs the candlesticks a little closer. You could get in for like scalping or intraday trading. We are at the 5-minute mark within the hour. See that flash down? That aggressive. You see how the spread just opened? The red line is the bid line. The gray line is the ask line. The red line is the ask line. And the gray line is the actual price of whatever you're looking at. So the gray box and the gray line is what Ethereum is at right this minute, right this second. When that red line, the space between the red line and the gray line is called the spread. See, Ethereum spread is 190. You can see the currency pairs, what their spread is. You can see NASDAQ up there, their spread whenever they closed at Friday at 5 p.m. 190 is not a bad spread for Ethereum. Just how quickly your investment goes into profit. Basically, that's what the spread means. How long it'll take before your sell line or your buy line gets crossed. If you're selling, it goes off what the gray line is. All right, we're about to see that in a minute. Let's just say I think this is going to continue to sell since it's still bearish after 5 minutes, even though it rejected. Starts you off with a 0.01 lot size, which is the lowest. You can adjust it accordingly. Let's just start off simple. See, a 0.01 lot size is, you always start off in the negatives, but it cost me, not cost me, but it started me off at negative like 20 cents, right? People don't understand the concept of going into the negatives right when you put your money into something, but it's just like as if you start your own business, you have to go get that supplies. Now that comes out of your pocket, so you're in down draw, you're in the negatives, but with faith and confidence in your business, you know that you're going to make that back times whatever. That margin level percentage is huge because I got in such a small lot size trade, and according to my $292 balance, that trade is so small that my margin level percentage is so high. The higher your margin level percentage, the more room you have to trade. Let's do this on the flip side. Let's do a 1.00 and let's see what the margin level percentage is. Under 100 now. I tell people you want to stay above 150. If you're at 150 or lower, you want to start watching your trades closely. Anything close to 100, you want to start thinking about getting out of some of your open trades. Now, when I hit sell, you see it picked up where the gray line was. For it to go into profit, that red line has to drop lower than my sell line. When it does, my red turns to blue, my negative turns to positive. Now, if I was to buy at that same level, then my buy line would be where the red line is, not the gray one. And then where my buy line would be at the red line, my gray line would have to cross above it before I go into profit. So that's how the bid line, which is the gray line, and the ask line, which is the red line, that's how they work together. And that's what it means to have a spread of a certain number, is the space in between those two lines, which is the distance it has to travel before you go into profit. All right, so usually people feel like it's manipulation because they feel like as soon as they hit sell, the trade starts going against them, and it happens every time. They don't realize that they're getting caught up in liquidity zones. The market makers are very good at grouping people who do the same basic average things as the rest of the people who read the same average textbooks, who set their stop loss at a certain level according to the last high and all that. Market makers know that people read all the same common knowledge, which is trash. So people feel like the market's manipulating, or it's a setup, or it's a scam, because they don't realize they're getting caught up in liquidity zones with the rest of the 90% of day traders who fell, right? Um, Shorting a stock is basically looking for, the first thing I look for is this reversal tilting of the market. All this bullish action, got some consolidation, it takes off again, consolidation, takes off again, reaches a high. So these highs broke these ones, this one broke these ones, and this one broke its last high right here, but its next high was a lower high. That's when you know that, okay, this might start reversing. Could get in a couple of sells right here. I wouldn't, because it's so close to the MA line and it didn't even come and touch it. These will either act as resistance or support or magnets or trampolines, how I look at them. But this is, so it's acting as resistance, right? Because after it was a trampoline and it bounced off, it started magnetizing. So it started pulling it towards it. But the best way to say that is basically it's resistance, right? Instead of a trampoline, it's resistance. The price was resisting away from this line, and price tried to come back to it but couldn't even touch it, and it started resisting again. But there is a structured resistance right here that it just cannot break past. And if we zoom out, we'll see that's gonna be aligned with another structure somewhere, and you can see it. The bottom of the candlesticks right here is good resistance. Came down, and once it tried to cross this line to the bottom side, it kept rejecting until it finally was strong enough to break that structure right here. So we got kind of the same thing going on right here. It's turned into a resistance line, a resistance structure zone, to where when the price gets around there, it can't cross it. And then the next attempt of price trying to cross that same line, it didn't even get as high as this high. So that's why I'm shorting Ethereum right now. Also because, as I was saying earlier, that M, the market is nothing but infinite M's and W's. There's M's and W's throughout the whole entire whatever you're looking at. Looking at this, you can see the left leg of an M. You can see the middle part of the M. Left leg. Here's, sorry. Here's the left leg. There's the middle part. Here's the right shoulder. And if the right shoulder is lower than the left shoulder, you know it's about to make the right leg. It's going to come down to the MA line. There was a teacher on YouTube who was saying, if you see this structure, if you catch a market at the top of a price reversal or the bottom of a price reversal, how do you find out how far it's going to keep dropping or how far it's going to keep pumping? The MA lines. I found this to become true like maybe like 70% of the time. If you are in a situation like this, like right now, if this was reality, confident in this sell, I wouldn't get out of it until it comes and touch this MA line. This MA line is at least at 2680. Since I'm used to what markets do and they come close to it but don't exactly touch it, prime example right here, headed towards it but doesn't quite touch it. But I know that's the middle of an M and the left leg touched it. Maybe the right one's going to come maybe in this zone. So this would be a safe take profit. 27.0540, right? This is how smart profitable traders do this. So my market target, my take profit, I'm going to do 27.0540. Come here, I modify order. This green right here with the green line under it, 27, modify. Now we see a TP, take profit line. That means when my price hits that line, it's going to take me out at whatever profit it's in. Let's say it goes the other way. I don't want it to go past. And people who do risk to reward ratio, they find out if they like trading 2 to 5 or 1 to 4 or whatever. And I tell people make the market make sense to you with risk to reward ratio. I did it with dollars instead of percentage. What I said was I'm willing to risk $2 to make 5. Meaning to me, I know this isn't what it means technically, but this is what I made it mean to me. Technically, if I was in down draw by $2 at a 0.01 lot size, if I'm in a sell and it starts buying and I'm in down draw of $2, I automatically get out of that trade no matter what, even if it reverses. I don't care. I'm only willing to risk $2 to try to make 5. If that trade is correct and it hits $5, I take that $5 profit out no matter what, even if it keeps going my favor, because it's about discipline. 2 to 5, I take $2 out. If it hits $2 down draw, I'm only willing to risk $2. If it hits 5, I take it out because I don't want to risk it dropping back under $5. That's how risk to reward ratio works for me. But what works better for me is technical analysis. It's what I'm good at. As you can see, I'm in profit now. Now that that red has came and met my sell line and moved past it, I'm in profit. Boom. Now what happens with the stop loss, I've already set a take profit line way down there. Let's just say I don't want it to reach, well, I'm at a standard 1 lot size, so I don't want it to go high at all, right? Let's just go back to open price. I don't want it to hit open price again. So we go to 2825. Now watch this. Now you see where my stop loss line is at, right? But since I'm already in profit, we can slide this stop loss into, we can slide the stop loss until it becomes a trailing stop, which means it won't take you out in the negatives. Now, no matter what, you'll get out in a profit after it goes into profit. So what you do, you go to modify order, and with the mouse or with the computer, this is way easier. You can hold your finger on here and wait, but so we'll go and we'll enter a number, right? So I see 2809 is a sweet spot. Boom, modify, boom. So now no matter what, it takes you out and profit. You can literally walk away from this the rest of the day, and on the computer, if you drag your mouse right on that line, it'll tell you exactly the amount it'll take you out at. So now you have a trailing stop and you have a take profit line. Like down here, if it reaches, when it goes all the way down here, man, what is it at, $190 already? Imagine, look how much it dropped from our sell line all the way here, right? Imagine how much money that's going to be by shorting this stock, by just realizing that this has to form the right leg of an M. Just by that kind of technical analysis, you understand? Like, just by that technical analysis alone, this is the left leg of the M, this is the middle part, this is the right shoulder, so it has to form the right leg of the M. By that alone, we were already correct. Everything else I showed you was just confirmation and confluences. Um, it can't make it to the overbought region. Its last attempt to do so didn't even touch the overbought entry line before it started rejecting to its lower highs. And this was its second attempt too, but it wasn't as high as the last one, so it started rejecting. We can slide our trailing stop down a little more so it could take us out in a higher profit, since it's kind of like way out there. Okay, see, it just tried to buy back, kind of. All right, so now you see our margin level percentage. It's above 150. That's what I said. About 150 is comfortable. Anything above 150 should be a comfortable region to trade. It's what I keep my eye on when I'm worried about down draw. If I'm in profit, then my margin level percentage should still be around 150. Shouldn't be dropping around 100 at all. Should be around 150 or more. If we're at 2806 for our... So now, if let's just say this market turns around and becomes a bullish market before the hour closes, if it does, it takes us out in profit no matter what. Our chart's already set. We're locked in. We set a trailing stop. We got to take profit. So we can literally close this and come back later and, collect profit. So yeah, we'll be back with that in a minute. Well, looks like it's going to hit my trailing stop. So let's just go ahead and witness it. One more. One more little pump to the top side. It'll probably go ahead and collect it. Let's see. 5, 4, 3, 2, 1, 0. Oh, there we go. Ate it, right? So, boom, we go back to that screen. Let's just go ahead and close that out. 0.01. Now we have $371. Go to our trade screen history. Today we have made $79.06 on this demo account. And it's, as I said in the outline on Discord, it's fake money, real market. This is really Ethereum. This is exactly what Ethereum is at right now. Had this been a real account with that much money in it, that's how much money I would have got. It even takes commission on some brokers, like some brokers do. This broker does at every 0.01 lot size, you see commission, they take 0.07 cent. So that 83 cent, they took 7 cent out of that. Do the math, at a 1.00 lot size, they took $7. But I made $85.30. So that's how that works. Gas fees, in essence. But yeah, you see that red bar right here on the left of the screen? That's because it hit my stop loss, but my stop loss was actually a trailing stop, so it took me out in profit instead of a negative. And that's pretty much how I short stock. I short them, man. I look for that tilting of a market. I look for the hanging man, which would be this. This is how I made $102 off of gold in three, and it only dropped $3 because I saw a bearish hammer. Here's the handle, here's the hammer, and it's bearish. You see how that hammer is at the top of an uptrend, is at the top of a bullish breakout? That means stop bullish action, price reversal. That hammer alone means I'm looking at this hour, and when it did this little, you can see a little wick right here, it did a little pump fake. The whole time it was pump faking, I would have been hitting sell. If it hit this level, I would hit sell again. If it pumped up here, I would have been hitting sell again, which is called counter trend trading. And the reason is because I'm confident it's not going to break this high. So if it would have pumped this level to this level, I would have been in two great sell positions for when it hit here and rejected and started coming back down. In this hour, as it's dropping, people want to jump in the sell, but it's chess moves as well. It's counter trend trading, so you should know that the market's already going to drop while it's pumping. So the whole time it's pumping and people were trying to buy, let's say this was, this did go up these levels. The whole time amateurs are trying to buy, trying to catch the wave going up, but the whole time I'm hitting sell because I know it's not going to reach this MA line. This MA line is rejection now. This one already got brought all the way back down. The Bears already won this war. So the whole time it's pump faking, especially if it's in the first 5 minutes of the new hour, I'm hitting sell every level. Because when it starts dropping after 10 minutes of the new hour, I'm collecting while other people are getting whipsawed trying to jump in a sell. I'm already in sell positions. Each level is dropping. I'm collecting. And I'm going to find the video of me doing that live as well. It's so beautiful. Counter trend trading is so lovely. And I do it shorting stocks. I don't know why I'm good at selling. I know it. I'm great at catching pattern reversals, price reversals at the top of the uptrend. So this would be a hanging man. This was only a hanging man because the confirmation would be the next candlestick after the hammer has to close lower than the hammer closed. And since this did, the hammer alone indicates price reversal, but some people like to wait for confirmation after this candlestick closes. But if you're confident in that hammer enough, according to your other confirmations and confluences, then you can just be collecting this candlestick. Like I said before, you should already be in some good sell positions when this hour opened because of that hammer. But these two together indicate a hanging man, these two bearish candles. And they indicate that the next couple of hours the market should be going underneath this candlestick. If it doesn't, you have to find out why, and it's because of this MA line right here. Or does it crash anyway? Let's see. Sometimes it does it, just not immediately. So no. The reason why is because supply already, this was already bullish. This was bullish, and when it dropped, it couldn't drop much further underneath this MA line. Price pretty much cruised above this MA line. So this hanging man becomes irrelevant because MA lines are more powerful than candlestick patterns. So MA line confluence took over here. And you have that flag pattern right here for bullish indication. But if we wanted to, we could come back and short this again, because if I still feel it's selling, let's do a little 0.22 lot size. They took $1.54. A couple of dollars in down draw. I'm not worried. You see the spread opening. That means either a lot of buyers or a lot of sellers are getting in. Which is the true one? I would say the bears. It's been bearish the whole 30 minutes. There's been bullish takeover, pullback, but it's been a white candlestick pretty much the whole time so far. So yeah, I'd stay in that sell position, set another stop loss, set another take profit, wait for it to go in a profit, drag my stop loss until it becomes a trailing stop to a comfortable zone, and then go about my day and come back and see how much money I collected.